So today, I guess we'll get started. So today we're going to be talking to a guy who's he has an impressive education resume. He's an author. He's a business owner. He's an entrepreneur. He's built a 7-figure portfolio from the ground up. Lloyd Ross.
What's up, Tony? Thanks for having me on. I'm excited. Yeah.
Yeah.
What?
So you're from Gold Coast, Queensland, Australia.
I am indeed.
Right?
The most eastern part of Australia is where I live, on the ocean there. So.
Oh yeah, that's awesome.
It's a long way away from everywhere, you know.
Yeah.
Yeah, we're from the U.S., so we have no idea where that is. I've never been.
I know. That's totally cool. I
looked it up on a map. It looked like a nice beach area. I was like, nice.
With what's going on in the U.S. right now, I'd rather be in Australia, to be honest.
Yeah, man. Yeah. It's so weird here. Like, we got team in the US. I literally just jumped off a call with our USA team.
Oh, really?
And coming in, like a couple of them are coming in remote and stuff, like wearing masks. And here where I'm from, no one has ever worn a mask during this COVID thing. So it's like, one of the most regulated countries in the world, Australia, and all of a sudden we feel like the most free. It's weird. Like we have none of this going on. So we're just watching the news thinking, all right, it looks pretty tough other places, so.
Yeah, I was going to ask you how the COVID situation is. So you don't have that many cases.
Nah, like I think, sadly, probably maybe 900 people have died, but there's very few active cases, like maybe 100.
Wow.
That's
incredible.
Really, yeah, we're an island, so we just closed it off. Like, we're just very lucky. So, yeah, I'm happy about that.
Yeah. So let's get into it. You wrote 2 books.
I wrote a book. I actually did write 2 books, but this particular one that I've recently written, Money Grows on Trees, is probably my number one book that I've written. So I'm excited about it.
How did you start, or when did you start investing? At what age?
I was 24. I want to say 24, maybe 23. I can't remember exactly, but it was in my early 20s, mid 20s.
How old are you now?
I'm 37.
Okay. I'm 33, so close.
Yeah, and I'm 22.
Oh man, you're a baby. You got it.
Anyway,
I was still in school, still in college. But anyways,
people used to tell me, "Hey, Lloyd, you're only 22. You got so much time." And I think I remember this one piece of advice someone said to me. They said, "You've actually got no time to lose," and that's probably the best advice anyone gave me. I didn't wait. I was like, "Let's just do as much as we can." So, what actually happened? And how I got into stocks. Because my whole family grew up around property. My dad's in property. Like I was heavily involved in property. I did sales and leasing of commercial property at 20. My whole town, all of Australians have this dream to just be in property. It's just like fad. It's just this, they have a fetish for property here. Anyway, so like I should have just been there. I was a property lawyer. I was a property agent. I did property overseas. I think after I read Robert Kiyosaki's book, Rich Dad, Poor Dad, I really just wanted to have cash flow. And so I realized that property just didn't provide that, because most of the time you got to borrow money to buy it. So I was thinking to myself, I'm saving my money up. I'm not doing all the wrong things. I'm just, not buying cars and stuff like that. So I have this money. How can I best plant this or deploy this capital and get some actual money back?
That's really interesting, because that's exactly what, I don't know if you listen to Dave Ramsey, but Dave Ramsey, that's how he went. That's how he got into big trouble, because he had too much debt and then they wanted all their money back. And that's when he started getting out of real estate as well.
Yeah, I love Dave Ramsey. I follow him a lot. Some of my stuff in my book's kind of inspired by him. I actually have 0 debt. So when I talk about Dave Ramsey, I'm really proud. I have 0 debt. And I think that's been one of the most beneficial things for me as I've matured as a man and grown up, is just not having that burden, behind me, squashing my entrepreneurial endeavors. Because if you have debt, it's really hard to take entrepreneurial risks, because you've got these obligations.
You're a slave to your debt. You're a slave to your debt. Yeah.
And all of a sudden people are like, well, I can't leave my job because I got this, or I can't do that. And I get it. It's bad when you got that burden. So I always try to avoid that. I guess I've been fortunate enough to not ever take the plunge. But stocks, what happened was I always used to think, and you guys probably were the same, I used to think stocks, when people were like, don't go on the stock market, it's risky. This is all I heard. And they're like, it's just charts. And I thought the whole thing was just about charts, which obviously now I understand to be technical analysis, which is fine. But that's what I thought. Anyway, I'm in the airport one day and I'm cruising across the bookshop. And I love airport bookshops, because I go in there and look at the business books and the success books, and I always find something and I'll get it for the plane ride. Because when you live in Australia, every plane ride is long. So
Yeah.
I buy this book. I see this book, Warren Buffett, The Snowball. And I'm like, that's really interesting. I love biographies. I'm just going to pick up this book. Apparently, this guy knows what he's talking about when it comes to stocks. So I pick it up expecting to be about charts and yada, yada, yada. Anyway, I read this book and I'm like, holy crap. It's about buying dollar bills for 50 cents. And it was just like this light bulb moment, like, boom, I get it. I just understood value investing immediately. And that's what kind of compelled me to buy my first stock, which is in Westpac Bank. I think I put $3,000 in there. And what I loved about that was I made my first $90 in dividends.
So you manage your own portfolio then. You don't have someone else. Yeah, that's cool.
I manage
it.
Yeah.
So I'm also pretty big into dividend investing. It's something I like a lot. I know Warren Buffett is he likes to talk a lot about how if you're giving dividends away, then you're wasting money and you're not using it to grow your company. But I also like to note that this is a guy that almost his entire portfolio is dividend stocks.
Yep, totally.
So,
yeah. It's a really interesting point you bring up there because, I mean, for Warren, it doesn't make any sense to pay dividend from Berkshire Hathaway because he knows he can deploy that capital better than his owners.
Mm-hmm.
And so he's like, I ain't giving you this money because I can do a better job. And I get that. But you're right. When he bought Coca-Cola and and these great companies, you bet he took the earnings.
Yeah. He's got definitely huge positions in Coca-Cola. And
massive.
And Coca-Cola's, I mean, the only reason you would really own them is for the dividends. They don't provide a lot of capital appreciation. So
Yep, definitely.
So your first investment was $3,000 and you bought it in bank stock.
I bought Westpac Bank. Yeah.
So what was your strategy when you were going into investing? As someone that, as people that might be listening to this that have no idea what to buy, I get that question all the time. What do I buy? What do I do? What's your strategy? How did you come up with a plan?
It's so interesting. I get that question a lot too. And I feel like I want to take my 13 years of experience and just pass it on to someone in a USB stick.
It's tough. Yeah.
You can't. It's this journey. Yeah. So one of the things I learned was, okay, number one, don't lose money. Like it wasn't ever about short-termism for me. I understood if I put it into a great company, the capital growth, my money will grow, plus I'll get this cash flow and dividends. And I was okay with that. Like I'm not in a rush to become rich, right? So I think the first step was like, I just needed to feel it. Like I needed to feel my way through it. Because when you set up your brokerage account and you open it up and you look at the stocks a bit and you kind of go, okay, I'm just going to buy this. It was just the feeling of I need to buy something. Like I need to start.
Oh yeah.
And I guess a lot of people are fearful people who read my book and do my courses and learn from me, they're fearful of that first step. But I knew I had to set up my brokerage account. No one taught me. I just figured it out on Google, right? How to do this, how to do that. And then I just needed to buy. So here's then what I learned. I grabbed the Intelligent Investor book and I read it like 3 times. And then I read some other stuff by Peter Lynch and some other stuff by Common Stocks and Uncommon Profits. And then all of Warren Buffett's letters to shareholders. I just became a Warren Buffett freak. I was like, I need to learn about this. And then what I understood was, I understood my own limitations. So I was like, Warren is spending like every hour of his life for the last 80 years or whatever it might be since he was 11 doing this. And he has team. He has a team now around him, with Ted Wexler and Todd Coombs, and he's got Charlie so I'm like, am I ever going to be as good as these guys? And so my mindset was like, let the ego go. I actually invested a couple of stocks and they went down a little bit. And I was like, I don't really know what I'm doing. So I was like, I did a lot of research into Berkshire and I put big positions into Berkshire Hathaway. And that's when I really made a lot of money because I actually said, I'm not as good as these guys. Why don't I just buy Berkshire? And man, I bought it at like $80.
Yeah.
Wow.
Plus B shares at $80.
Berkshire is basically just an index fund. You're buying an ETF.
Yeah. So do you think for the average investor who doesn't have all this time to, research and whatever, do you think index funds are the perfect strategy for the average person?
100%. 100%. In fact, I'll go a step further and say ETFs, so exchange traded funds, are probably even more effective. So index funds obviously don't trade on the stock exchange.
Yeah.
Whereas
Right.
So so I think if you have an ounce of like some interest in stocks, probably an ETF because you can actually see it. It's kind of fun. And then as it falls, you can buy more. And so it works like a stock. It trades like a stock. Whereas an
Exactly.
index fund, if you buy it directly from, say, Vanguard, they will have it in a fund and you can't see a trade. So it's not as fun. It's not as exciting.
Yeah.
So I guess it's good for people who can't be trusted to like hold on to their money when the market collapses. If you're like, you're going to freak out and sell, do an index fund. You can't see it. But, you know, except for every quarter when they give you the report. But the ETFs, you can see every day, right? So trade. So I think an ETF, I prefer them.
Yeah.
Is wonderful.
Absolutely.
I mean, you know, you guys know, I think if an ETF is the market index and a large majority of active managers can't even beat that index
Yeah,
after fees,
exactly.
why would you muck around with anything else, right? Unless you kind of loved it and it was a passion.
Especially if you don't know what you're doing. I have so many people that'll message me and be like, "Oh, I bought this some penny stock, you know, a
Oh,
couple
yeah,
dollar stock. What do you think of this? I bought 20 shares." I'm like, "Okay, do you have a 401k? No. Do you have any other investments? No. Okay, sell that stock, buy an ETF." That's like my like
totally.
buy ETFs for a year, learn what you're doing, build up some type of a little bit of wealth and it's like a
Yeah,
safety, and then start doing your trading, you know?
100%. Yeah. I mean,
So I'm glad
Warren Buffett,
you kind of have the same sentiment.
yeah.
So
I mean,
yeah,
totally. I mean, it's just, I've made mistakes where I bought this and I just should have bought more index funds. Like I even make mistakes where I was like, you idiot, your ego got you in the way again. You should
Mhm.
just done that. And I think what's fascinating is that I love in Warren Buffett's will to Astrid, his wife, that when I go, I want 90% of these funds you get left with to be in an ETF or an index fund. With
Yeah.
yeah.
Vanguard, he even says Vanguard.
VTI, right? VTI, I
Yeah,
think.
yeah,
Yeah,
yeah.
yeah,
And then a little bit in bonds, you know, for
yeah,
liquidity. And I think,
yeah.
I mean, that's just, he literally just gives away the best investment strategy of all time for everyday people, and people just still make mistakes on it. I'm like,
No
that
idea.
is
Yeah, no
crazy.
idea. It's
Yeah.
so when you first so this like I remember when I hit milestones in my portfolio, I'd get excited like you hit your first $1,000, you know, you hit $5,000, you start
Yeah.
taking pictures, you're like, "Oh, I did it."
Yeah.
When you hit
Yeah.
your a million, when you hit a seven-figure portfolio, you
It,
can't tell me
yeah.
you didn't take a photo and pop some
I
champagne.
have I have a photo. Yeah. If what's interesting, I have a photo. Oh, it's so weird. Like when it goes past 1 million, you feel like your life's gonna be like, oh, I'm a millionaire exchange, but you're like, it's
Nothing's
like
really changed.
you feel like the Bud Light commercial is going to come on, like all these chill. Yeah, you're like, oh, something's going to happen, and you're like, oh, it's like what happened to Elon Musk the other day, right? Like, so he became the richest man in the world when
Mhm.
Tesla went past whatever it hit, you know, 700% return. He's worth 200 billion, and he sailed past. He's like, oh, how strange.
The interesting about that is people on Twitter don't understand. He can't just pull that like that $1 billion out immediately. Everyone thinks he should just give his
No,
money away. He's so rich. He has to go
Yeah,
through processes to withdraw that by the SEC. I think he has to like put in a couple of months notice if I'm
well,
right about
totally.
plus
that.
it'll destroy Tesla if he just took
Yeah,
all his stock out.
Yeah.
I don't think
But
he's interested in that. He's not interested in
no,
that. You know, like
he
it's
wants to
like me.
change the world. So
Totally.
sorry,
And
go ahead.
it's when you hit your million, you also don't just go, oh, take it all out and go and buy a Ferrari. It's just not how it works.
Yeah.
Like I think what right now with my portfolio, what's really fascinating about it is it also took a massive hit during the pandemic back in March. So what happened was like I'm a holder. I don't try and time bear markets or anything. I don't short stocks. And so I'm like, I'm holding my way through this because Charlie Munger says, you know, famously, if you can't see your portfolio drop by 50%, a number of times throughout your journey, it's not for you. So I knew it was
Right.
going to happen. I'm like, I'm holding on. I had some spare capital to make some purchases, which I did. But I saw my portfolio fall by like 300,000 or something. And so it became less than a million. And when I'm making purchases back there this year, I purchased some travel stuff and then, you know, some more things here and there. But as it's positioned now that as the recovery happens this year, it will go way past a million, you know, it'll,
Yeah,
Do you think that's the reason most people like pull their money out and that's like a big
they panic. Yeah,
it's a big
yeah,
roadblock to getting rich. I think a lot of people panic when they see their money going down
yeah,
and they just pull it out,
yeah.
especially like
Well,
beginners.
I
totally. I
did
mean,
that when I was new. I saw it drop like $10. I'm like, I'm done. I'm done.
yeah, I'm out. Yeah. You know what? It's really like that's where the research and fundamentals and understanding of financial literacy comes into it. Because if you do understand the fundamentals, you know full well that if you own a really good quality index fund, that those 300 companies or those 500 companies that you hold all have to go broke at the same time for you to lose everything.
Yeah.
The only way for that to happen is like a war, not even that. Like that didn't even happen during World War II even. But like a meteor has to hit the country or our country has to sink in the. They're the type of like big long tail, black swan events that have to happen for you. So I'm like, I say to people all the time, like, if you lose, we got some bigger problems we need to worry about besides your 100,000.
Yeah, when the stock market crashes, you should be buying more, like not selling.
It's so hard though.
Yeah.
It's so hard. Like here, I'll give you an example where I made a mess of myself personally this last year. The stock market's falling and I've got my eyes on this great company and I've been watching it for ages. It's a good growth stock and it pays a dividend and it's growing and it's like a market leader. Brilliant. In the travel industry, incidentally. Anyway, COVID comes, it gets hammered. It dropped by like 40%. And I start buying because I'm thinking this is going to be like SARS and MERS, the Australian bird flu. I'm like, there's no way they're going to shut down countries and stop. I mean, the chances of that happening are low. And I was wrong. And so
here we are a year later.
and I'm like, and I'm like, the stock's falling. I'm like, whoa. I'm like, okay, dropped another 20. I'm like, buy a little bit more. Did a little bit more. Man, this stock, no joke, I started buying at $9. Went from $14 to $9. I started buying at $9. And it went to then $7. I was like, oh, okay, a bit more. Then it went to $4. I was like, uh-oh. Bought a bit more. Then it went to $2.50. And they do, and how about it? Bain Capital comes in, rescues this company on a bailout that they couldn't find. They couldn't find capital, like equity partners to buy out, like to bail it out. So I'm thinking, this is going to be my biggest loss. This is bad, right? Bain comes in, rescues it with 25 million capital injection. I'm like, oh my God, that's amazing. And they offered a one-time rights offer to existing shareholders of $1.70. So I just backed the truck up at $1.70 and I just tipped in whatever money I had.
Yeah, it's definitely a lot more riskier when it's not an ETF. It's a lot more scarier.
Totally.
Yeah.
And I mean, travel, COVID, I'm like, this is bad. But thankfully I felt really good with Bain. I felt good at the stock offer. And what's happened now, because I put so much money at $1.70 and I kind of put my balls on the line, so to speak, it's now I'm square and I've got an average cost price of that stock at $4.50. And that's a really good entry price now. So I got to wait.
The good thing is you're in the position to be able to do stuff like that because you already built up your solid portfolio that you have a lot of experience and you're not going to panic. And it's tough for a beginner. So
totally.
My question is, how much of your portfolio do you have in bonds and commodities?
Okay, great. So I have none in bonds.
Wow.
I would say that right now I have 10% of my portfolio in cash. I don't have any, and I would say by cash, I mean, it's in an interest-bearing account at bank.
Yeah.
So you could say it's bonds. Like it's the same. It's guaranteed by the government.
Right. How do you feel about like gold and silver, buying stuff like that?
I'm smart in areas and I stick to those areas. I don't really go outside my circle of competence here, but why I don't like not getting cash flow. Like every position I have in my stock portfolio produces cash flow, a dividend.
Yeah.
Right? So my biggest position is Australia's biggest bank, CommBank, and I got a ton of money in there. And it's like an index fund almost because it owns almost all the companies, pieces of the companies in Australia. And then the rest is like in Vanguard, VAS.
Yeah.
And then in, some other little stocks. But like I've got my two core positions are quite big. And then I've got these other ones around it, but they all produce dividends. So I don't like commodities and gold and Bitcoin and these things that don't produce cash.
So what do you think? What do you think of bonds? You don't like them?
Well,
when you're 37, you don't really need too many bonds.
Yeah. But you know what? Like if your portfolio is set up correctly in stocks, let's say index funds and big core positions that are really good quality, then you're investing for cash flow. And so like my portfolio could get crushed by 50% and I'm still getting paid income.
Yeah.
See, that's what I was talking about when Andrew and I were talking about this earlier. I like the investing in ETF or dividend ETFs like Charles Schwab or Vanguard high dividend, because when the market crashes, it's like, my stocks are down, but I'm still getting paid,
Totally.
You just feel better about it when you have that income coming in, even though the stock's getting hammered. But so you don't. I'm sorry. Go ahead.
Well, it's like, you talk about as I get older, let's say my hope is that I'm 60 and 70 and I've got like multi-million-dollar portfolio that again, I think the idea is, well, they need to spend their capital out for retirement, but I never want to touch my capital. I only ever want to add to it and grow it so that I'm not spending any. So like, let's say I'm retired and I'm making $500,000 a year in income from dividends. It doesn't matter. Like,
yeah.
You know what I mean? Like it.
Yeah.
And with bonds, the income is fully taxable.
Yeah.
And it can be hurt a little bit by inflation, obviously. And they just don't have the same earnings potential as stocks. And so they don't grow as well. Like equity returns.
Right.
I think I see Dave Ramsey say something like that too. I was listening to him the other day and he said something very similar to that. Yeah.
So
I'll try to be a disciple of Warren Buffett.
So tell us about let's pivot a little bit. Tell us about the secret side hustle. What is that?
So that's interesting. God, I mean, I think back to in my early 20s, when I was working and then I got a job in corporate and I was like, all right, I really just want to, I understood Robert Kiyosaki's cash flow quadrant. I knew I had to move from the left to the right. I wanted to move to the investor quadrant because I wanted my share portfolio, my assets to produce all of my income. So I was completely free. I mean, I understood that early in life and I was like, I want that. And so here I am working corporate, I'm saving money, I'm buying stocks, but I'm thinking to myself, this is a really freaking long time. Like this is going to take me a while to get my $1 million portfolio. And I was like, and you can make it in like great investments. You can invest in an amazing stock like Afterpay and like it's a 10 bagger and you just make $1 million. You can, but I'm just not that good. So I was looking for ways to accelerate or increase my earnings, increase my income, because I knew if I could just double my income somewhere else, man, that's all gone in stocks. I will double my portfolio growth compared to the average. So I'm working away. I'm in business here in Australia with my dad. And we got a property business. We had a property business back then, and I'm earning okay money. And my sister comes along with me and says, "Look, I found like this, product business. We should do it." So my wife and I and her hunkered down. We built this side hustle, marketing health products around the world online, and this thing started to produce like $300-400 a week. And I was like, wow. And like you guys, you put $300 or $400 into a compound interest calculator, right? Into an ETF over 30 years. You're like, whoa, like it's huge. So I'm like, I knew that. So I'm like, well, I want this. I want $400 a week every week, and I'm going to put it here. And this is how I'm going to make my millions. That was my idea. So that's what we did. But then what happened was once we got paid like $1,900 for the week, is like $2,000 for the week. I'm like, whoa. This is $100,000 a year extra we're earning from our side hustle. This is tremendous. I mean, it's a life changer. So we're like, let's spend a bit more time at it, obviously. And so we did. We hustled. We did a bit more. And it just grew into this beast where it now is our core business. I left my property business and my wife and I just run this as a core business. And it literally has helped me accelerate my portfolio to the million past, what we have now.
That's amazing. That's amazing. Congratulations. I mean, you're killing it in the game of life. You're killing it. You're 37. Yeah. You're a millionaire already. Like you're working for you. It's great.
Yeah, it is. It's turned out that way. It's been quite a journey. It's been a journey, man. Like, I mean, you just want to fill your days with just working towards your dreams. Like that's like what you guys are doing. I think people underestimate the compound effect. They understand the compound effect with money, but they sometimes don't understand the compound effect with your work and your life. Like what you're doing now with this, like as you keep going for the next 10 years, it's like putting a pot on the stove. When you first put a pot on the stove, you don't see the bubbles.
Yeah.
It starts to boil away. And then eventually the bubbles disappear. Like, whoa. Yeah. Like for me, this is a culmination. These last couple of years have been a culmination of like a decade.
Mm-hmm. Yeah, it's all about consistency for
once
sure.
Once you start seeing success, you just want more and more, and you keep pushing to get better and better.
Yeah.
Yes. Yeah. So I know you're an avid reader. You follow a lot of investors. Have you read a book that I actually just read? I loved it. The Richest Man in Babylon.
I read that when I was 17.
See, if I read that when I was 17, I would probably have $1 million portfolio too, right?
Yeah. No, it's really interesting. In my book, I talk about that story, how that book came about, and I actually talk about that specific book in my book. I hope everyone, look, I hope your listeners pick up that book. It is amazing, right?
I am going to pick up that book because I actually like everything you're saying, and everything you're saying is stuff that it helps me, it helps solidify like how I'm investing. I feel a lot better about it. And I think it's important too, because we want to preach these values to people that don't know what they're doing, instead of trying to make money on penny stocks and ridiculous things, you know?
Yeah. I kind of lay out the plan of how I built this in my book. And if people read it, they get the framework of what I did. I even talk about ETFs now. I talk about Richest Man in Babylon. What happened to me was when I was in school, people say, oh, didn't teach me about money in school, which they didn't, but they did teach us to read, add up, and write. And I don't think people use those skills well enough to make money, right?
Well, I think the biggest thing is your foundation, your family foundation. Like my family, my mother and father never talked to me about investing. Never. Nobody in my family really ever talked to me about investing. And I feel like if I had that in my life, I would have done it, but I never knew anything about it until I hit my 30s. And then I started investing, and then I would tell my brother Andrew, I would tell my younger brothers, I'm the oldest. Now I have them all investing. Like, you guys are in your 20s, you need to start, because I started so late, like,
Yeah. Look, I was the same with my brother, like my younger brother. He was spending a lot, and I'm like, man, let me teach you this. And I did. And as soon as he got that first dividend check, his whole spending paradigm shifted, and he doesn't. He's got like a $250,000 portfolio at 31, which is really cool for him. He's in the army, man. He's in the military. He's in Iraq right now.
Really?
Wow.
Yeah.
That's amazing.
And so he's built this with being steady. So like, I think back to Richest Man in Babylon. What I love about that is it teaches the fundamentals of getting your first savings together.
Yeah, pay yourself.
That's your money tree thing, man. Yeah, that's your startup stock money. You need that first, So.
A lot of people will look at guys like you, or millionaires, guys that are, rich guys, and they'll be like, oh, well, he must have did something, he got lucky, or he got a lucky break, or oh, he screwed somebody over to get that money. And it's like, well, you could be rich too. You just gotta, if you did what this person did, you could be rich too.
Yeah. I feel like
you have to put in the work.
Totally. And I mean, it's about being aware of opportunities, and then they're disguised as hard work after that. But what happened to me was, I remember being in my grade 11, I think, or grade 12 English class, of all places, English, the last place you expect to learn about money. And my teacher said to us, his name was Mr. Barber, I remember, he said, gentlemen, if there's one thing you do when you leave the school, I want you to read 2 books. And I was like, what's he talking about? And he said, I want you to read Rich Dad, Poor Dad and The Richest Man in Babylon. And he told us why. And I was just like, I must have been the only dude in that class that I was like, oh my God. And I ran out and grabbed those books. I read them. And I feel like Mr. Barber really put me on this path. Like, so that's an opportunity that I got. Maybe the other people got it. They didn't see it,
Sometimes when you're I was always pretty good with saving money. I always had a good savings, but when in my 20s, I definitely made stupid purchases, and I wasted money going out to eat like too many times a week, and just buying things you don't need, buying the newest iPhone, or buying the newest this, newest that, instead of investing.
Yeah.
But so that's what we're trying to do with this podcast, trying to help people learn from my mistakes, but everybody's mistakes when you're in your 20s. A lot of people make those mistakes. And having someone like you on is just such a great tool for people, a learning tool for people. Yeah. Someone that has the success that you have, and it's great. And we don't want to take up too much of your time, but I do want to ask you 2 more things, if you don't mind.
Man, I'm stoked that you asked me. I'm happy. I love giving value to people who need it, right?
So what's the 2 hot topics right now in the market? Everyone's talking about. Everybody's always asking me about it. Is Tesla and Bitcoin. Tesla.
I did 2 posts on this exact topic on my Facebook recently, which is fascinating. So I'm glad that we're going to talk about this. So which one do you want to talk about first?
You know what? Let's talk about Bitcoin.
Okay. I don't deny the blockchain technology. I don't deny that crypto's around. Like, it's going to be around forever. It's fine. Like, accept it and understand. It's a blockchain technology with a currency that you can use without it being controlled by central banks, and you can do things with it that aren't controlled by government. Cool. Great. Amazing. doesn't mean it's a good investment.
Yeah.
The technology, wow, amazing, and all this, like, we're going to save the world and this type of stuff. Fine, and it could, and I feel like it seems to be emerging as some sort of digital gold, so a reserve or store of value, which is okay too. I'm okay with that. That's cool. Yeah, makes sense, and I'm good with that. I'm not going to diss it and say it's not going to be around or whatever. But here's the thing: really, 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 really poor investment choice, because A, it doesn't produce any income. Okay, that's the first thing. So it's not going to give you any freedom. Yeah. The other thing is this: if an asset doesn't produce an income or an earnings or some sort of profit output, you cannot value the asset.
So you're talking about dividends when you say that? Or
well, earnings.
Well,
so
also it's just not backed by anything. There's nothing. Bitcoin is just. It's just a computer algorithm. It's hard to explain it to people.
Well, here's the thing: you can't value it because it has no assets itself. So, like, if you value a bank, it's got actual stuff. If you value a mining company, it owns trucks and mining leases and equipment and IP. There's things that it owns, right? That you can easily value. But Bitcoin doesn't own anything.
Yeah.
Right. So hard to value it based on a tangible asset valuation model you can do with stocks. But the other thing is it has no earnings.
Yeah.
It doesn't earn anything. Yeah. So to value a stock, and Warren Buffett talks about this too, is you actually take the expected future earnings of this business, you discount them back using a regular, standard discount rate, which is quite low at the moment, and it gives you a roundabout intrinsic value, a rough guide as to what it's worth for your money. So you can deploy your money in it, knowing that it's going to earn this type of money into the future. And that makes absolute sense. Same as a farm. You can do it with a farm. A farm's going to produce this. It's worth this. This is what I'm prepared to pay for it. And you can actually decide if it's too expensive or cheap. You can decide that based on your analysis. You cannot determine if Bitcoin is overpriced or underpriced because you cannot value it. Yeah. So what I mean by that is this. Someone says the other day, right? Talking to this guy, he made a ton of money, I know, in Bitcoin. And I said to him, okay, what's it worth? He said, well, I think if it falls to about 20,000 is good. I'm like, based on what? Just how I feel. Yeah. Right? If you have a just how I feel investment philosophy, you are going to lose a tremendous amount of money.
Yeah.
So some people got lucky, but here's the thing. I said to him, listen, are you prepared to buy it now? It was at $40,000 US or something, right? He's like, no, I feel like it's a bit high. I'm like, okay, great. So how can you tell people to put money in if you're not comfortable with it right now? Where is your logic here? And then he said, if it falls, I'll buy more. I'm like, falls to where? He says, if I knew that, I would short it. And he doesn't know.
So
another thing, I was just going to say another thing. We can go back.
It's so interesting.
Go ahead. Go
ahead.
Oh my God.
No, I was going to say, I was talking to someone about this on a Facebook group, and this guy was giving advice to someone who asked, should I buy a Bitcoin now? And he said, no, wait till it's high right now. Wait till it pulls back. And I'm like, well, first of all, pulls back to what? And second of all, how do you know if it's high or low? Like, who knows what it is? And how do you know it's going to pull back? It might never pull back.
I was going to say, we could look at the stock market returns. We can go back and we know the stock market's going to keep going up based on the past. Well, we expect it to, but there's really no past for Bitcoin. It's only been around for so long.
Well, there's a thing in finance, behavioral finance, called recency bias.
Mm-hmm.
And it's a really big topic in behavioral finance if you research that. But I learned about it when I was studying for my CFA charter. And recency bias really gets in the way of people's investment philosophy because they're basing their future decisions on what recently happened. And this is what gets people in trouble when they're trying to buy into a bubble. If the recency of Bitcoin just did this, it's recently in my mind, so I'm expecting the same, right? It's same as pandemic. You watch. It's because it was close. It's the next few years will be like it's in our mind. We think it's going to happen again, but not, right?
Yeah.
So same with Bitcoin. And the thing with stocks is that those businesses are run by, like, it's a real thing that produces actual value to the world and actual money. Like, you can see how the growth of technology and stuff's going to progress the stock market. You can see it. I don't know what's going to progress Bitcoin. There's so many different cryptos out there. Why is Bitcoin a special one? You know what I mean? It's weird. It's like a basketball
For
card.
sure.
There's also a cap on it, right?
and
I
it's
think.
Yeah, the supply caps.
21 million shares. Yeah.
Yeah.
But it's like and the average person, it's 40,000 a share. What are you going to do? Invest $100? What's that going to do for you? You know,
Yeah.
it just doesn't make sense. But
It's
yeah,
speculative. It's speculative. Like, it's a gamble. As long as you understand that, you'll be fine. So like, put 5% of portfolio in it. Done. Then then you can still brag to your friends that you pick Bitcoin, yada yada yada. Great. But don't don't build a portfolio.
That's what it is. You don't have Bitcoin. I have Bitcoin. That's what it is now. Yeah. It's like Tesla, which leads us to our next subject. Tesla's the same. I just don't understand how a car company is worth so much more than, Apple and Microsoft and Amazon. And, it's like, how does this make any sense that and they don't even make money. If it wasn't for the subsidies, they wouldn't even have a profit.
I know. Yeah. And so the thing with stocks is they don't go up because of the earnings. They go up because of the expected earnings. So in the short term, it's a voting machine. In the long term, as Warren Buffett says, it's a weighing machine. So it's getting votes right now based on its future potential earnings, right? So that's what's pumping the stock up. But this weird thing with Tesla is it's got this weird cult following behind it. And I think it's attracted a lot of retail investors that love the vision of Elon. And so they've kind of bought in the vision through the stock. And that's what's really probably given it this extra bubbly effect, that he's got a fan base that's just buying, right? And they're unsophisticated. They just love it. And what's happening is they're buying it like a hot potato. So it's a bubble essentially. And it's only worth what someone's prepared to pay for it tomorrow. So it's not based on fundamentals. Yeah. And what I find fascinating about Tesla is that Michael Berry, you know who he is?
No,
I do not.
He's ever seen that movie, The Big Short?
Oh yeah. Christian Bale.
Christian Bale plays the character. Anyway, he's actually a real dude. He's a reclusive value investor, very clever. He shorted the housing market when it was in bubble territory for all these same fundamental reasons. And he has the big short position on Tesla.
I did hear about that.
And so I'm like, I don't know if I want to own
That's
Tesla
interesting. That would scare me.
Yep, that scares me. I'm like,
yeah.
So I don't think it's going to last. But here's the thing. Going back to index funds, if you own VOO, right, you have exposure to Tesla now. So it's like, don't worry. Like if it's going to, get some exposure that way. Same thing. Like, put 5% of your portfolio in Tesla and expect to lose it. You'll be fine.
Yeah, I was just recommending that to a friend. He had Tesla, VOO, QQQ. I'm like, why do you have Tesla and all these index funds that have Tesla in it?
Yeah.
Just sell Tesla and put your money into
it. Activity is the enemy of the investor. And unfortunately, people love to be active. They just love to be doing stuff to make their money. And what's fascinating is it takes me like a year sometimes to put down one position. And then I'm done. I'll probably be done for another 12 months, maybe longer. That's how I trade. That's how I invest. I don't trade in and out of the market. It's too hard.
So do you try and beat the market then, or?
I'm
just wondering because I know that. Go ahead. Sorry.
If it was my core focus, I reckon I could probably do that for a while because my capital is low compared to the big hitters, right? And my costs are low. And I can get into stocks that are pretty, low liquidity. But I feel like I can build a bigger asset base and bigger portfolio if I actually make money in my businesses and just invest it in some more passive assets. Yep. I feel like that is more beneficial long term. Mm-hmm. That makes sense. I'm better to spend my time in my businesses. Yeah.
Yeah, that's what me and Tony do. We have pretty much in all ETFs. So
Yep.
Yeah, I have a real estate ETF, a dividend, a VOO, international, try to cover everything.
Do you know what? If you're, for your listeners and anyone who's watching this or listening to this, I find the objective with share market investing and particularly index investing is, in my mind, the idea is to actually build something that gives you more passive income than what your life costs. Like that's the objective, right? Mm-hmm. Like that's the goal. I feel like that needs to be the goal, because if you're not 100%. Doing that, what do you escape? What are you doing? Like build the freedom vehicle and then you get to spend your time doing whatever you want.
Yeah. So instead of having an IRA, would it be smarter to have an individual brokerage account and then try and retire earlier? Is that what you're suggesting?
Well, yeah, it's really fascinating because I don't have a superannuation fund or an IRA because I'm a self-employed business person.
Mm-hmm.
So like I'm I'll put plans in place to create one and get it going. Like, it's important because of the tax advantages and so forth. But what I focused on was actually building up a portfolio in a trust in a company entity where I could use the cash flow, because once it's in an IRA or a superannuation fund, you cannot use that.
Exactly.
So I'm like, why would I handcuff? I'm like, that made no sense to me. I'm like, yeah, I know there's going to be some amazing gains at 65, but guess what? I don't want to live when I'm 65. I want to live now.
Exactly.
I could be dead at 65.
Exactly.
I don't want to,
Yeah.
Exactly.
so I'm not all for that.
That's
I think
why. That's exactly why.
there's some tremendous tax advantages for sure on the way in and on the way out. I'm not debating it. And I feel like if you've got it going on, great. But yeah, I think if you're making enough money, have both. But I love that I get my dividend check and goes into my bank account. I can buy coffee with it. Like, come on.
Mm-hmm.
So how does, sorry to cut you off. How does dividend, so in the US, for dividends, we have a dividend tax is the same as if you were to sell a stock, but you have a long-term capital gains rate. So if you hold it a year or more, I don't know if it's the same in Australia.
You know what, dude? I really feel sorry for the Americans and the North Americans and whoever's in those markets, because what happens in those companies, you guys have the companies and the market grows more, right? Because they spend most of their time buying back stock, and they're just better quality companies, so they do perform better. But the dividends, because they're fully taxable, it's hard to become a dividend investor there. There's no incentive. You're like, oh, I'm just going to get taxed. So I totally get that it's a more capital growth model, totally. But here's the thing in Australia that we get, which is amazing. It's called imputation credits. And it's where like certain companies, and a lot of them, the major companies, the government is already taxing their profits. And so when they pay you out the dividends, it's after tax dollars they're paying that to you with.
Wow.
So I need to move to Australia. Right now.
I'll give you an example. With CommBank before the pandemic, CommBank, it was paying it's a really good quality company, 5.5% dividend.
That's awesome.
Tax free. Up to 30% marginal rate, right? So like it's mental, man. Like it's so good.
Banks are a no-brainer. Banks are a no-brainer dividend because they're not. The government's going to bail them out. If something major happens.
Yep.
So that's amazing.
I feel like we're on the same page.
Yeah. Do you have anything else to add, Andrew?
No,
I'm all out of notes.
Yeah. That was an incredible conversation. My mind is spinning.
That was great.
There you go. I'm really glad.
We don't want to take up too much of your time, but we really appreciate you coming on today. And I feel like this conversation will definitely help a lot of people. So
yeah, that was awesome. Thank you so much. We appreciate it.
Can you tell us where we can get your book, where people can go, what website?
Okay, cool. So the website is moneygrowsontreesbook.com. It's quite a long one, but moneygrowsontreesbook.com.
We'll attach the link in the description.
Cool.
Too,
yeah, awesome. But if anyone wants to follow me on Instagram, like I post a ton of free value on there. My handle is Lloyd James Ross.
Awesome.
Yeah, I'll throw your Instagram in there too.
So. Cool. No worries. Awesome. Great.
Right. Thanks again.
So much,
we appreciate it.
It's been awesome. You guys are awesome. Thanks for having me on. I appreciate it.
Thank you.